So scrolling through YouTube, you might have seen videos like these. Is this a video about the stock market or a trailer for the show Fallout? So YouTube thumbnails like that makes you wanna do something urgently. You wanna sell before the collapse. But before you push that sell button, I want to show some analysis and research that you should take into consideration. Here's a graph of the S&P 500 with dividends being reinvested for the past 20 years. We can highlight multiple periods when the stock market falls. Sometimes this can happen very rapidly. Here's a list of the 10 worst days of the index during this period. They are clustered around during the global financial crisis and COVID. But to avoid these days, you're also running the risk of avoiding the best days of the index. These are the best days of the index for the same period. They are also clustered around these volatile periods. And not being invested in the best days severely impacts your long-term results. Here's what happens to the long-term performance avoiding the best day, the 5 best days, and the 10 best days. So are there any signals or metrics we can use to try to time the market? Well, one of the most cited metrics is the so-called CAPE ratio, which stands for cyclically adjusted price to earnings ratio. You take the price of the stock market, in this case the S&P 500, and you divide it by the average earnings seen over the past 10 years, and you adjust it for inflation. Since the CAPE ratio is using 10-year moving average of earnings instead of just 1 year of earnings, we can smooth out the business cycle. High number means that stock prices are high relative to historical earnings and fundamentals. On paper, this sounds nice, right? When prices are deviating from earnings and fundamentals, wouldn't it make sense that we lower our allocation? The American investment management firm AQR did some research on this. They looked at using the CAPE ratio to time the market, increasing equity allocation when stocks looked cheap and lowering equity allocation when they looked expensive according to this ratio. The good news is that this strategy has outperformed the simple buy and hold strategy for more than a century. Bad news is that there has been no outperformance for half of that sample period. Since the 50s, we can't observe any outperformance. And this is also before any transaction costs in the backtest. So the CAPE ratio seems to be an insufficient indicator for us to use for market timing. But there's plenty of other stuff we can look at, right? Another paper from Dimensional looks not just at valuation metrics, but also at other concepts like mean reversion or momentum. And they applied them not just to the United States, but also to the developed market, excluding the United States, and also emerging markets. In total, they looked at 720 different timing strategies, and they found out that just less than 5% of them outperformed the simple buy and hold strategy. That's great, right? We finally found our money-making machine. Well, not so fast, right? As they write in the paper, these strategies were very sensitive to the parameters that they used. Changes like the sample period or the region or specific parameters used in the strategy, if you change them, it's going to have an impact on the outperformance. And since they tested so many strategies, it makes sense that some of them would outperform. It's kind of like when you ask enough people to flip a coin 5 times. Eventually, one of them is gonna flip 5 heads in a row. That doesn't make it significant. So should we be worried that we can't really time the market? I did some simulations of a scenario where you receive $1,000 each year that you can invest, but for different times of each year. You can either invest it immediately as a lump sum into the S&P 500 or split the amount into 12 parts that are invested at the start of each year. This is a form of what's called dollar cost averaging. I'm also going to compare it to the best possible timing strategy, that is, you buy at that year's low, and the worst possible timing strategy where you are buying at the year's peak. Of course, these last 2 strategies are not replicable, right? You can only know the high and the low of the year after the fact, but it's just for illustration purposes here. Then I will simulate this for 10 years and I'll compare the final worth of each of these cases. What's most important in my opinion is that even the worst possible timing strategy, that is, you invest the 1,000 at each year's peak, still outperforms sitting by the sidelines and putting the 1,000 in a cash deposit account. So think of this next time you hear yourself say, I want to invest, but the market has gone up so much recently. Historically speaking, it has not paid off waiting by the sidelines and not being invested. So in conclusion, maybe you should not try to predict the unpredictable. You are not that guy from The Big Short. If you are though, hit me up. As they say, what matters is not time in the market, but rather I did the opposite. What matters is not timing the market, but rather time in the market.